Did you miss out on the market correction and fail to buy the dip? Are you looking for an entry point, but you're concerned about buying at the top? Well, let me tell you about an options put contract that I recently wrote on an energy ETF. By using this type of strategy, I can receive a higher rate of return while I wait on a stock or an ETF to drop down to a price that I consider a better entry point. Before I tell you how it works, let me tell you what exchange traded fund I'm talking about. It's XLE. That's the broad-based energy ETF that has holdings in the oil majors like ExxonMobil and Chevron, as well as the non-integrated producers and the shale oil and natural gas companies like Occidental Petroleum and EOG Resources. It also has holdings in refiners like Valero, service companies like Schlumberger, and pipeline and infrastructure companies like Kinder Morgan. So it's a very well-diversified energy company. It pays a reliable dividend, and if you can get it for the right price, it's an excellent position in your portfolio for either a short-term trade or a long-term hold. The key to investing in a volatile market like energy is to try to avoid buying in at the top. Now let's look at a chart over the last 5 years. You can see that prices have come down significantly since 2014, when we had an oversupply of shale oil, which resulted in a commodities collapse at the beginning of 2016. And over these past 3 years, the market's been consolidating and range bound at a price in the mid-70s. Obviously, the best time to have bought into XLE would have been during the panic points to buy in at the dips. And you can see that these lows are very well defined, with the lowest point at the commodities collapse in February of 2016, and then the recent sell-off in December of 2018. And to further buttress these defined lows, you can see that the long-term horizontal trend line appears to offer strong support at around $53. By applying a 50-day moving average, we can get an idea of the personality and the behavior of the stock in relation to its 50-day moving average. So when the stock is in an uptrend, the 50-day average acts as support, and when the stock is in a downtrend, the 50-day average acts as resistance. Now let's tighten up our timeline to 2 years and focus on some more recent behavior. Over this period of time, you see that XLE is conforming to its 50-day moving average, and the center of gravity for this trading range seems to be right around $65. The ETF is currently trading just above that level at about $66. If we want to try and define some of the lower limits of this stock, we can draw in another horizontal support trend line, which falls right around $59 a share. And of course, we know there's support at the 50-day moving average, which is right around $62. So while it's looking that this stock may be breaking out at $66, it's also had a significant run-up since the December lows. And if you're concerned like I am that this current breakout could fall apart in the energy sector, then you might want to wait to purchase XLE until it drops back down to one of those previously established support levels at $65, $62, or $59. I'm choosing to sit this one out, but rather than just keep my money in cash, I've entered into an options contract where I've sold a cash secured put with a strike price of $61. The $61 puts me right in that range, below the 50-day moving average at $62 and above the horizontal trend line support at $59. Let me tell you about how this contract works. I entered into a contract that doesn't expire till the end of the year. I'm agreeing to purchase at $61, which I think is a fair price and an entry point that I'd like to get into this position for either a short-term trade or a long-term hold. And after transaction fees for selling this put, I'm receiving a premium of $2.94 per share. Now this put is a cash secured asset contract, meaning that $61 has to be available in cash or in some type of a cash equivalent fund that's being held by my broker. It's sort of like an escrow account. I'm not using leverage. I'm not using margin. I have the money ready and available in my account, and it will stay there until the contract is assigned or expires. So if we take that premium that I've received, the $2.94, and divide it by the $61 per share that I have to keep in escrow, you can see that over the life of the contract, which is approximately 10 months, that I'll receive a premium return of about 4.8%. And so that works out to an annual rate of return of around 5.76%. But wait, there's more. As I mentioned, my funds are being held in an escrow account. And currently, my broker is paying an annual rate of more than 2% interest on that money. Now, it's a variable rate and it can go up and down, but presently it's somewhere around 2.2, maybe 2.3%. So if you factor that additional interest payment into the put premium that I'm receiving, then on a comparative annual rate of return, the total yield would be at least 7.6% and maybe even closer to 8%. Now, obviously, this option strategy isn't going to make you rich overnight, but I don't ever invest in any type of get-rich-quick schemes. I'm looking for a reasonable and competitive rate of return on my assets, and in this case, since I would likely want to own XLE at $61 a share, I think that it makes sense for me to write this put, collect the premium, and if XLE does not drop to $61 a share or less at the end of the year, then I get to keep the premium. If it does, I buy in at the entry point that was already acceptable to my investment strategy. Well, hey, how will this all work out? We'll keep checking back, and if the contract is assigned or when it expires, I'll let you know how it all worked out. Until then, as always, this is John Pugliano wishing you the very best returns.